So thanks for tuning in. I am joined today by Adam Rakowski from Ortis Financial, who is a financial broking house based in Sydney and the Gold Coast. Adam, welcome. Thank you for coming in today.
Thanks, Joe. Good to be here.
No worries. So we are right on the precipice of some big interest rate cuts. There's been a lot of talk in the market over the last 6 months about when is this rate cut coming. There's a lot of people, I'm sort of seeing a lot of people sitting on the sidelines waiting for this rate cut, both investors and owner occupiers waiting for that rate cut to come. A lot of people are sitting on their hands. So from your perspective, obviously you talk to all of the lenders. Yep. You've got a huge panel of lenders. I'm sure, you've got a really strong view on when you think this rate cut is going to come. When's it going to come and how many are we going to get?
Yeah, when will rates get cut? Great question, Joe. I think, been a long time coming. I think, the hard part is, information's out there all the time. People, read and digest the news, and property's always at the forefront of that. But I think now, the signs are clear. It's been November 23 was the last increase. So we've had a year and a half of nothing. And I think people had an expectation that there'd be movement earlier on, but there were always an excuse. Inflation was a bit high. But if you're looking at all the metrics that exist now, it's clear that it's now a matter of when, not if. I'm a very positive person. I'd like to think that next Tuesday there would be a rate cut. And again, anecdotally, we get a lot of clients calling us, and there's genuine apprehension out there, and we get calls regularly, people trying to balance things and the like. So I think that, it's clearly there, and I'd hope that the Reserve Bank does the right thing, and because there's no real excuse anymore, and the market is behind in terms of, look at New Zealand, the UK, and the US. Their sort of core inflation is actually higher than ours, and they've all started to ease already.
Yeah, and certainly, with that last inflation number coming down 3.2%, coming within the range that the RBA said they wanted to see before they'd cut a rate, would indicate that rates are going to come down. And all the banks have all come out and said they're expecting a rate cut in February. So my money is saying that a rate cut in February. I'm not a banker though. That's why I've deferred to you. So it's nice to see that you share the same view. What about subsequent rate cuts?
Yeah, so how many cuts will there be? Great question. I think if you look at the history, and it isn't always a good barometer, but it is still relevant. Look, we're at 4.35 now. We've been there since November 23. Again, I'm pretty old here, but in 2008, I think GFC, we got to 7.25. Outside of that, in 2012, we were at 4.75. So at 4.35, where we are now, we are at a higher setting than we typically see. Look, the market is pricing in probably 50 basis points, right, initially. I'm of the view be more like 1%. That would be a cash rate of 3.35. Probably by the end of the year, I would suggest. Look, if we're unfortunate and they don't move next Tuesday, the next meeting is on the 1st of April, and they only meet 8 times in the year. So look, my view is we will see a cash rate of 3.35 at the end of the year, and again, prepared to be sort of called on that. But yeah, again, looking at all the metrics and the underlying data, there's just no excuse anymore. Wage growth is kind of pretty weak across all the various metrics that you can look at. And again, a good sign, actually on the way here today, I noticed that St George and Westpac dropped their 1-year fixed rate to 5.99.
Which is usually a surefire sign that they're banking on a rate cut if they're dropping their fixed rates.
Look, the banks aren't dumb. They're clever, and they obviously want to entice people to consider their options. And a 5.99 1-year fixed rate is quite enticing, because I think that would be akin to the best rate in the market. If I was to say, what is the best rate now that's variable, it's 5.99, give or take. So they're offering that to you as a carrot for 1 year. But yeah, my view is that you'd be sort of taking the unders there. Most people are probably paying, again, anecdotally in our portfolio, we had a look, about 6.3, which again is a tad high. So you get 2 rate cuts and you're in the black there.
So someone taking out a mortgage today, should they fix or should they wait for further rate cuts and then fix, say, in December once we reach the bottom of the cycle?
Again, another question, fix or not to fix, we get a lot. Obviously, it is dependent on your situation. We do have we have a diverse client base. We have people who are nurses, teachers, paramedics. Sadly, their ability to earn variable remuneration is tough. So people who are looking to stretch or upsize or borrow towards the higher end of their capacity, if they've got a strong emotional belief that they want to just fix a portion to give them that comfort, of course, that is something to consider. But again, anecdotally, I think we've written 700 home loans in the last 9 months in the business, and I think one person is fixed. So if that is a way to answer your question, I think that, again, without getting too technical, when you have a fixed loan, you can't offset generally. So again, having that ability to use your free cash. So I think the banks are trying to entice you to fix with those rates, but yeah, I think variable is on balance going to be the most preferred option.
So hold off until you get to the bottom of the cycle.
Yeah, and again, like I said, it's there. All our sort of other similar Western economies have already started to cut, and they started with a higher inflation than we are. So we are quite conservative here. I think it's a tough job coming in as the new RBA governor, and she copped some flack. But I think it will help in that once we have one rate cut. Again, my belief, and you look at history, there'll be a whole series. And even at 3.35, which I'm sort of suggesting will be the rate in the year, even that, in my opinion, it'll go a bit lower again. If you look at history, there haven't been too many times in the last 20 years where it's sat at that level. In fact, you're probably looking in the high twos, maybe 3 is where it might level out, in my opinion.
Okay, great. So, from where I'm sitting, working with buyers, there's a lot of property investors that are just sitting on the sidelines waiting for that rate cut. As I said before, I'm telling them don't wait, because once that rate cut comes, there's going to be a lot more competition, a lot more buyers, people will have more capacity. What do you think will be the effect on investors when we see that rate cut?
Yeah, I think the impact on investors will be pretty swift. And whilst I think the market is pricing in that rate cut, so I don't expect an overnight change. But to your point, Joe, confidence and sentiment is what drives the market, particularly for investors. So I think that, again, anecdotally, I find that's a good way to sort of give people a picture. We have at the moment 44 people who are pre-approved, just sort of waiting on the sidelines. And that is the highest number we've ever had in our business. So we would normally have 18 or 19. So again, that gives you a good idea of people who are there, they're pre-approved. The bank has said you can do it tomorrow. And sure, stock is sort of limited in some markets, but by and large, they're waiting. They don't want to be the first to move. And I think certainly you're right. Borrowing capacity is linked to the cash rate. If it goes down, borrowing capacity improves. So competition, there's just built up demand there. So I think that, as you would know, more competition just has an upward pressure on prices. So whilst, again, I don't think it'll be an overnight thing, just the sentiment alone will make it more challenging, because people will have the confidence to that extra 2 or 3 or 5 grand, whatever it might be, and that already creates that sort of momentum.
And have you already seen a shift with to more investor lending than owner-occupied? I know there's been, last year there was more, for the first time ever, there was more investor loans than owner-occ.
That's right.
Is that a trend that's continued into 2025?
We've seen a definite shift towards investor from owner-occ, partly driven by affordability. We have a lot of our clientele live in capital cities, mainly Brisbane, Melbourne and Sydney, who, driven by affordability, initially look to go elsewhere and buy an investment interstate.
So rent investors?
Yeah, potentially, or rent investors, but people just also have, they want to buy an investment property, but just limited by what they can buy in their own capital city.
Right.
And so, yeah, a lot of those people are very commonly, again, we've had the business for 8 years, and I could count on one hand the people who in the first half of that who would buy interstate. Now every second person that I talk to is wanting to investigate. I want a freestanding home. I've got budget of 700,000. I live in Sydney. I can't buy that. Where can I? And obviously, buyers agents are a big part of that and helping them unlock markets outside of what they know. But definitely, and again, I don't see a rate cut of 25 basis points, which we might get next week. That's not going to change that swing. I think if anything, people will be confident to keep.
It's going to give the confidence. That's
the
right.
confidence again. That's the key thing here. Like I think everyone knows that the RBA is meeting next week, and it's not a surprise in the headlines. So I don't think it's going to be a jolt, like I said. But yeah, just the confidence to act, knowing that if you are towards the top end of your comfort zone, there is relief coming.
Yeah. And to that point, what other impacts do you think a rate cut would have on the broader Australian economy?
Yeah, look, huge impact as far as property on the economy more broadly. It is a huge thing culturally as Australians. And again, we've mentioned it, but just sentiment. Like it's funny how often markets are driven by that feeling. And I think we see it in our business. We're a growing business. You mentioned, Sydney, Gold Coast. We're in the throes of trying to hire 10, 15 people. And as a business owner, property is part of my sort of personal situation. But when I'm making choices as a business owner to enter a new market or bring on new people, there's a correlation there. So if the confidence is there, whether I'm looking at getting equity out of a property to invest or just comfortable that my position is such that I can bring on that second or third person, that is a very strong link, which I believe this will impact positively. People who, because like people in property, businesses have been on the sidelines. If you look at the job ads and that kind of stuff, it's been very flat, and it's sort of simmering away. So I actually think, again, the impact will be more broadly, people will be confident to act, invest in that business, try that new product development, and there's a strong correlation. And the first domino to fall, hopefully, will be next Tuesday. But if not, 1st of April, I think, without a shadow of a doubt, so not too far away. And that'll just drive that circular economy.
Yeah, and look, it's no secret that rate cuts impact first home buyers and families with mortgages in the mortgage belt, but there's also a flow-on effect of that to the other market segments. So people in the prestige end who aren't particularly borrowing, downsizers, and people who are sort of above that 2 to 3 million mark. Yeah. How do you think that rate cut will affect those other market segments?
Yeah, the impact of the rate cuts will vary on the segment. You're right, and I think if you look at, again, historically, which I like to do because it gives you perspective. Sometimes, let's say there's a 1%. I'm right for a change. There's a 1% rate
Fingers crossed,
cut.
let's hope so.
I think historically the top end has responded more positively, and I think it's roughly a 6% increase in values just off the back of a 1%. Cut, and again, that I think is just sentiment. There's no science behind that, but the last 2 times it's happened, it's been like an instant thing. And you're right, at the top end, typically they're cash buyers, people who have had the benefit of ownership for many years and have equity, and over time been fortunate not to go to the bank. So that it does all start there. But equally at the bottom end, you mentioned in terms of borrowing capacity. Look, I feel very strongly about that because we do have diverse client base, and the buffers we apply, the banks apply, should I say, to what you can borrow, they were adjusted during COVID from 2.5% to 3%. And we haven't gone back, which to me is not the right thing to do personally. And I think that thankfully now there's dialogue happening around maybe looking at different cohorts differently. So today actually came out some news that the government has asked APRA and ASIC to review how they look at HEX debt, for example, when it comes to borrowing capacity. So at the moment, effectively, if you've got HEX debt, it's a huge burden. So, which is not fair because HEX, if you're unemployed, for example, or if you don't earn a certain threshold, you don't have to repay it. So why the banks? So all these things, I think, again, tie in at the same time. You've got the rate cuts coming, you've got business being more confident, and you've got changes to borrowing capacity rules for the people that need it. Those things all come together at the right time. I think, again, what is the common link is positive sentiment and feeling. And again, that is going to be the initial reaction. And I think there'll be but yeah, the top end does always drive that part of it.
Yeah, and certainly from what I see with buyers who are in that top end, prestige buyers, typically they're business owners. They benefit from a boost in the economy. They feel more confident that their businesses are going to perform, and therefore, they're happy to go and spend the money, even though they're not affected by rate cuts because they're cash buyers. It is, as you say, the confidence.
Yeah, I do. And again, like we've got a federal election, due in the next sort of quarter. It's also always a dynamic. It's interesting as far as which way that government goes, because whether you lean one way or the other, obviously how they react to policy and property. Like we've had negative gearing on the agenda the last few elections. That seems to be off the table now. So there are things that will, I think, again. The way it's trending around the world, incumbent governments have had a challenge to stay in business, so to speak. So again, if that was to happen here, not that I've got a view either way, but that would be more positively viewed by the property market than if the incumbent stayed in. I think it's fair to say. So again, another factor which could conspire to come together to just give a sort of a nice road to recovery. It's been a tough 3 years almost. May 22 was the first rate increase, and it feels like a long time, and it is. And so people have been doing it tough, and I think we owe it to sort of everyone that we bounce back.
Yes, and when those rate increases came, the market just kind of stopped, and it wasn't until we had our first rate pause that people jumped back into the market because they thought, okay, we are at the top of the cycle now. Yep. Which is good. But the other effect, obviously, on rates will be the effect on the Aussie dollar, which has been very weak. And, the US has strengthened, which actually makes Australian property look quite cheap. Well, not cheap, but it looks very attractive to expats and overseas investors. Have you seen an increase in your business in expats and overseas investors looking at Australian property and wanting to get finance?
We've seen a huge increase in expats coming to us for finance recently. I think you're right, driven by the exchange rate. Most of our clients who are expats are in Singapore, Hong Kong. Again, tax rates, as you know, Joe, they're favourable. So if your job security is good, and you're earning good money, you're paying less tax. The exchange rate, and of course, a lot of expats, they often come back. They go for work reasons, typically with a plan to come back. And so, yes, definitely, we see a lot of activity, a lot of inquiry, and I think that'll only increase. Obviously, with our rates coming down, that'll maybe sort of taper off slightly, but more broadly, it's still a weak Aussie dollar, and we are sort of a bit of a sheep in a currency. We don't. Not a market maker with our currency, so I think that that'll continue. But funny on that point, the banks that lend to expats it was only a small bench to start with. Recently, one of the big players exited, so again, I think that there's some challenges there for expats because you've only got a couple of options. But I think for both of us, we do a lot of work in that space, and definitely the inquiry. Again, I think sometimes that's always a good sign. The level of inbound inquiry around borrowing capacity and looking at properties, that will tell you that in 3 months' time and further, that's going to be, they're all going to land as far as people buying.
Yeah, certainly the expats that I talk to, they value a property in their currency, and they say, it's actually quite cheap. They're not looking at it in Australian dollars. They're looking at it through the lens of their currency in the city where they're residing.
Correct. You're right. And again, I think
money.
I agree. And I look again, it's obviously relative. It's not cheap for many of us who live here and pay the tax here. But yeah, you're right. There's no doubt that some of those markets that we're talking about, property there is even more expensive. So it's relative. And I think that again, just the level of inquiry we're getting is telling me that it'll be a sort of a big back end of the year, which again, to tie into our sort of theme here, another cog that will add to the general theme of positivity that will come our way.
So finally, one last question. If you had some advice for anybody who's looking at buying this year, whether they're an investor or owner-occupier, what would that advice be?
Advice for a buyer? Look, I think it's quite easy. I'm a huge believer in expertise and having people in your corner, so to speak, who are taking away the downside for you. And and that's things like having a buyer's agent, going to a broker, having a conveyancer, solicitor who is experienced in that field, if you're an expat, they do work in that field. I think it's hard enough, whilst there's no doubt the average buyer is more informed, there's information everywhere. It's almost information overload. You probably see it all the time, but people can go into CoreLogic and look up property reports and think they're a valuer, and it'll spit out a range. I think it's a positive thing, but there's almost too much information. And often the banks in my world don't actually put it all out there. The policies aren't, it's a bit opaque. So again, we advocate very strongly in our business for buyers agents. What Joe, you do for our clients and your clients, it's just a phenomenal de-risking of the process. Obviously, people look at it one way, but for us, when we get feedback about the buyer's agent process, it's about taking away all the noise. And again, we've all got lives we have to live with, family and jobs. And I think, like us as brokers, we work for the client. We take in the information and we sort of disseminate it and recommend the best for that person. So again, doing it yourself is noble, but I think in the long run it can actually hurt yourself, because again, you can make mistakes very easily. And I think it's fair to say that for most people, buying a property, whether it's a house or an investment, is one of the biggest things you'll ever do. And yet people want to do it themselves. So yeah, my biggest advice is definitely surround yourself with people who have done it before.
A professional network.
They're acting for you. They have they're acting for you. Again, if you're in your world, you're buying from a sales agent, they're acting for the vendor. They may be friendly, they may be doing the right thing by you. You think at the end of the day, they're not acting for you. And you want that person, whether it be a broker, a buyer's agent, a solicitor, looking at your best interests and taking away the potential pitfalls. So that's definitely the overarching thing. Just and plan. Don't go in tomorrow. Like, we have clients calling us, say now in February, going, "Oh, Adam, we're going to buy in November." That's not too soon. Let's talk now. Let's talk through what you're trying to do. So we kind of encourage people to come to us as soon as they have the thought in their head.
So specifically, what advice would you give to people looking at taking out a mortgage this year and buying a home?
Okay, so yeah, advice around mortgages, again, self-interest here, but go to a broker, whether it's me or someone else. Again, put simply, look, the banks play an important role, and they provide capital for people to go and buy property. But even for me as a broker, and I've been sort of in finance for 25 years, trying to navigate the constant evolution of policy and change, going to your bank to get a loan is just not advisable, because they can only offer you their own product. And again, in our life these days, we're used to comparison, and I think that's quite a good thing for the consumer to have that. And I think with mortgages, it's no different. It's our job to understand what's out there. We've done 700 loans in 9 months, and we see it all. So we've taken the situation, understand where to navigate, what to do, what not to do, because again, it's just too hard. The choice is a positive thing, but it also becomes like a paralysis thing. There's too much out there. So again, definitely talk to a broker where they act for you, they take any situation, which is unique every time, and they can direct you to consider options that otherwise you may not have even known about. So, and again, once you're in a loan, so to speak, it's not as easy to just get out of it. So again, just take the time and talk to someone who actually can give you perspective and optionality.
Great. Adam, thank you so much for your time.
Thanks, Joe. Pleasure. Thank you.
We'll see what happens next Tuesday.
Fingers crossed.